I used to sell a lot of cash secured puts as a way to generate an income from the stock market, but recently I've been selling more covered calls. Why? Quite simply, you make a lot more money from them. And personally, I actually believe they're safer. Today, I'm going to show you over the last 30 days the exact trades that I've taken, a cash secured put and a covered call campaign on the same stock for the same period of time, and how one of them generated me $560, one of them generated me over $2,000. Now, firstly, what even brought me to the point of wanting to sell covered calls as opposed to cash secured puts? Well, the one thing that I couldn't quite get right in my mind is that if you are assigned on a cash secured put, you are already in a loss. And over the years of trading, when I look back, any time that I had taken a loss on a stock position is a stock position that I was assigned via a cash secured put. And the reason why is that safe level of support that you sell at now becomes resistance, because the only way you get assigned is if you dropped that level of support. So let me take you into the charts, into this trade that I've taken, and I'll show you the exact trades that I took and why it worked out in my favor to be selling covered calls rather than cash secured puts. So the stock that I've been trading lately that I absolutely love for this is Credo Technology. Let me start walking you through the trades that I took. So the first trade was on December 12. I sold a $130 January 16 cash secured put and I received $560. Now $560 on a cash secured put at $13,000 capital, that's a 4.3% return. That's awesome for a cash secured put. But there's always a but. Here's my $130 mark. Right, so I sold it on the 12th, which was here. 130 was my strike price, and you can see that we've had some good support through there. If we drop that level of support though, we're likely to land probably down here where we've had some support before, so around this sort of $100 mark, give or take. Now, from all-time highs down to 130, my strike price, that's about a 30% discount of all-time highs. For me personally, I don't care about how much cheaper I'm getting a stock from its all-time high, because I much prefer to care about the fact that if I get assigned at 130, the stock's trading below 130, and it's likely to be around this sort of $100, 102 mark, which means that to get back to my entry price of 130, we need to climb 27 odd percent. So that's the issue that I was finding with cash secured puts, is that if you get assigned, you're behind the 8 ball. And granted, we can wait it out, but that's time out of the market when maybe you don't have to. So at the same time as waiting for my cash secured put, I also bought shares and entered a covered call campaign. Let's see what that looks like instead. So here's all my transactions here. These are my trade receipts. I wanted to show you my trade receipts to show you I actually took these trades, but they're not very logical to read and see. It's much easier to see laid out like this. So on December the 17th, I bought 100 shares at $140.35 each, and I immediately sold the $142 covered call expiring on the 19th. For that, I received a premium of $391 straight into my account. Now, what happened on the 19th? We were trading above $142, so my shares got called away, resulting in another profit of $165. Which is the difference between my 142 that the shares were sold for and my 140 and 35 cents that I bought them for. On December 20, I wanted to do this all over again. So I bought another 100 shares, this time at $148.71. So let's quickly go back into the chart December 20, where are we? December 20 would have been Friday the 19th because I'm in Australia, so I'm in the future. So my 20th is US 19. So on this day here, I entered again. Notice that I didn't mind that I was buying at $148 because we were in a trend that I preferred the look of. Now, I didn't sell straight away my covered call. I was expecting that we might get another green day or two. And if that was the case, I was going to wait until we'd had those green days to then sell my covered call. But it didn't happen. We dropped back down a bit, which is okay. So I bought sold on the 24th, a 152.50 covered call expiring the 26th of December, and I was paid $185. On the date of the 26th though, I bought it back, cost me $6 to buy it back. So for that week, my total profit was $179. On that same day, so I did this as a roll. On that same day, I resold the 152.50 for the following week, January the 2nd, and I received $284. January the 3rd, which was January the 2nd. January the 2nd, I bought it back for $3. So I had a total profit of $281. And I immediately sold the 152.50 again, this time expiring January the 9th for $231. On January 9th, on expiry, I bought that one back as well, which cost me $94. So then I had a total profit of $137. Now I could have let this one go to expiry because let's take a look at the chart. January 9, my strike was 152.50. January 9, my strike was 152.50. We closed at 150.42. So I could have theoretically let it expire worthless and I still would have kept my shares. However, if I'm going to do that, if I feel like I want to keep my shares, I much prefer to roll it on that same day if it looks like we've got upward momentum, because I will get more selling the call on the Friday than I will on the Monday because of time decay. Okay, so that's what I did here. Where were we? So I bought it back for 94, total profit of 137. And then this time I immediately sold the 155 expiring January 16, which is today, for $580. Now, again, we were trading below 155 at end of day today. So I bought that one back for $10, profited a nice $570. And this time I immediately sold next week's for the 157.50 expiring next week for $347. So selling weekly covered calls, so far I've got a total of $2,070 in profit. That's already sitting in my account. Now, if I wanted to exit this trade now for whatever reason, I could have. I could have bought back that call today or let it expire today, and I could have sold my shares. Remember, I bought my shares at 148.71, and today we're trading at 150.97. We closed at 150.97, so call it 151. So I could have closed out that position entirely today and still received, give or take, $200 in price appreciation. But I've chosen to keep them and just keep this cycle going over and over and over and over again. But if I did exit that today and sell my shares without this premium, and instead with $200 worth of price appreciation, I'd still be at $1,900, over $1,900. Now, if I get the call away at 157.50 next week, it's another $879 worth of price appreciation. That would bring my total to $2,949, which on my total capital, so total capital, I've just taken, assuming the whole thing's at 148.71, it's a 19.8% return. versus my 4.3% return on my sold put, even without the capital appreciation. 2070, 13.92% return, 560 at a 4.3% return. And here's the cool thing. If for some reason the stock does drop back in price now, I've received over $20 per share. So my 148 is now a cost basis of 128, which is below the original 130 strike price that I had. And there are other cool things that I can do. I can continue to ride this up. Maybe I get to a point sort of up here where I think we've topped out and I can do something really cool, and instead of just sell a covered call, I can put a collar on it. That's a story for another day. That's a video for another day. But basically a collar means that I can take advantage of the upside and also make money on the downside. So that's why I have transitioned a lot of the capital that I had available for selling puts to just simply buying shares and running covered calls instead. Weekly covered calls. It gives you so much more flexibility. It gives you so much more opportunity. But here's the key. You've got to do this on a quality stock. Don't go looking for cheap stocks. Just because a stock is cheap doesn't mean it's good. So I hope you found this video helpful. Let me know in the comments if covered calls is something that you do regularly, or if you generally stick to cash secured puts, and what your thoughts are. If after watching this video you feel like, you know what, maybe it's time to do some more covered calls. I would love to hear from you.